Okay, well, thank you very much for coming back so promptly. I hope you brought your glasses with you. So for those who haven't met me yet, I'm Thorsten Beck. I'm the director of the Florence School of Banking and Finance, and we're very happy to host this fourth edition in this academic year of the foundational course of the Supervision of Digital Finance Academy, together with our colleagues and friends at DG Reform and our friends and colleagues at the three ESAs. Now, I think this is the fourth and the final for this academic year. So I just mentioned we're going to have 6 of these actually next year. So again, your feedback, your comments, suggestions would be very welcome. And I should have started with saying welcome, because it's the first time I'm speaking here, but it's at the end of the 3rd day, so maybe it's a bit awkward to welcome you here. But anyway, by the way, if nobody has told you yet, we are here located in the Villa Schifanoia, and I think it's very kind of a nice contrast that we are actually here in a villa of the 15th century, I think, and talking about things of the 21st century, things that's digital finance. I think it provides a nice contrast. Okay, but now, you didn't come here to listen to me, you came to listen to our keynote speaker. It was supposed to be a dinner speech, well, it's now a pre-dinner speech, so that's why I hope you brought your drinks with you. I'm very happy to introduce Ignazio Angeloni, who many of you might know. For those who don't know him, he's a long-time central banker and supervisor. He's not just a supervisor, he's one of the supervisors who helped build up the single supervisory mechanism in the euro area, in the banking union. And since he has retired from the SSM, he has been actually continuously very active. We're very happy to count him as a part-time professor here at the Florence School of Banking and Finance. And he's also, doesn't just look at, he's not a supervisor who just supervises, but he kind of thinks also ahead. He also likes to think outside the box. And I think that's exactly what the kind of thoughts he's going to discuss or share with us today, and hopefully also give, again, material for discussion. I think it's, the title was Pitfalls in Supervising Digital Finance. So very much looking forward to this. Thank you very much, Ignazio.
Many thanks, Thorsten. I have to say, I was prepared to give a few lightweight dinner remarks. And now we are in a classroom, first of all. Then I see you've put on your tie. So this is...
Well, you have a tie, that's right.
Oh,
put it on for you.
I always wear a tie. You don't. No, I just want to spend a few minutes, first of all, congratulating the group here for, this is the 4th foundational weeks of the Supervision of Digital Finance Academy. I've had the pleasure and the honor of participating and advising a little bit on how to set up this academy. I've participated to parts of the previous 3 weeks, and I have to say, I was impressed. I was impressed by the quality of the presentation and the discussion, by the intensity of the participation on the part of everybody, I have to say. Very nice discussions. And of course, the organizational side was done very well. So I congratulate everybody, and I understand that the authorities are appreciating this effort, and so this will continue next year with more weeks and a lot of activities in the context of this academy. What I thought I could do tonight with you is to share some of my ideas and reflections that the participation to the previous 3 weeks and part of this week have stimulated in my mind, and see whether this can perhaps give rise to some discussion here. The first thing that came to my mind, maybe this is the main message I want to convey to you, is be careful about the expression digital finance, because it can be misleading. There's a lot of talk, there's a lot of hype about digital in general, and about digital finance in particular, and also digital money, but that's another subject. And if you hear the general discourse, either in the press, even more in the social, to part of the academia as well, you may get the impression that digital finance is something different from finance. That we live in a new world, okay? So now everything is digital, so forget about the old rules. Now we live in a new world. And so everything is sort of governed by this new digital framework in which the world operates and finance operates. This is not so. Finance is still finance. It has its own rules. It has its own function in the economy and the society in general. It has its own risks. It generates its own problems and requires the same attention from regulators and from supervisors. Then there is digital. Then there is actually a number of technical means to conduct finance, as well as to conduct many other things that we do every day. But this is an overlay, so to speak, on something which is still very traditional. And many of the things that we observe every day in the financial sector, or we read in the press, problems that come, reveal that the fundamental problems of finance and the things that the supervisor have to pay attention to are always the same. Now, digital can change certain risks, can increase or decrease certain risks, can modify certainly the modalities in which finance market participants operate. But it's an overlay, as I said. It doesn't change the fundamental characteristics of what is going on. So my recommendation to you is try in your mind frame, whether you supervise an instrument, an intermediary, a negotiating platform, a market structure, etc. Whatever you supervise, try to keep the financial element separate from the digital side, and try to understand the business model of what is going on, to identify the risks underlying, and then, of course, in connection to that, consider what is the impact of the digital modality, the digital form in which this takes place. So I could stop here. This is my main message. I'm going to entertain you for another few minutes. First of all, saying what finance means to me. I'm not a finance theoretician. I'm an economist by training, but I've, on the workplace, I've developed a certain expertise. What finance means really to me. And then a few examples maybe in the digital finance or the crypto world of today where these concepts can be applied. So to me finance is basically 4 compartments, okay? That's my mind frame. So first of all, there is payments. Payments is not really finance. Payments is transfer of wealth. Why do I say it's not really fine? I hope I'm not offending anybody, but why is it? Because the purpose and the risks involved are different. I mean, there is a purpose, and it's fundamental. There are risks involved, but they're very different. So I put in my sort of mental compartment, I put it a little bit on the side. Then there is finance proper, and the center of it is intermediation. Intermediation can be market intermediation, can be institution-based intermediation, banks, asset managers, etc. Still intermediation means connecting saving to investment. So ensuring that the connection between what is saved and the people who save and what is invested and the people who invest is as smooth and as efficient as possible. Now this is fundamental not only for the economy, but for society. I mean, society cannot prosper and cannot grow without the proper intermediation. Then there are a couple of other things. One, to me, again, this is the third compartment, so to speak. This is diversification and hedging, so protecting yourself from risks. The risks of intermediation, that's the center of everything. But diversification and hedging, it's another chapter. And then arbitrage and speculation. I would regard arbitrage, I don't know if Thorsten would agree, but I would regard arbitrage and speculation and hedging and diversification as ancillary functions of intermediation. So functions which are important, also because large part of the experimentation takes place in these areas. But they are important insofar as they help the intermediation function work well. Right, so this is the thing. So, and if you look at all the more modern things, if you think about Bitcoin, if you think about stable coins, if you think about Terra Luna and all these very strange things, you must be able to locate in these things and to understand each of them in terms of what contribution they provide to the four functions that I have, and where each of them is useful, is needed, and as a consequence, where the risks come from. Okay, so let me start. I have a couple of examples, and I have a list of them that I put here. I don't think I will be able to cover all of them, but I have Bitcoin, and in general, all cryptocurrencies supported by digital distributed ledger technologies, similar to Bitcoin. Bitcoin is by far the most important. Then I've marked here collateralized stable coins like Tether, for example. So stable coins that have upfront a portfolio of assets that they try to keep, with which they try to keep the liability stable. Then platforms like FTX, negotiating platforms, which of course it's very much in the news nowadays. Different instruments like Terra Luna, for example, algorithmic stablecoins, still stablecoins, but have a different balance sheet structure. Payment infrastructure proper, like Klarna, for example, which, however, have a credit component into it, and so they are sort of a mix of intermediation and payments. And then, more in the payment side, payment apps that we all use every day, and ending up to CBDCs, which I'm not going to cover because they don't need to be supervised by you. They are self-supervised by the central banks. So let's forget about CBDCs. I'm not a friend of CBDCs, by the way. So let me start Bitcoin. So Bitcoin is by far the most important, the popular press. It's the thing that you hear most often. So Bitcoin is, to my mind, is an outside asset. Am I right or wrong? It's an outside asset in the sense that it's not the liability of anybody else. Okay, so it's like gold. It's like a piece of land, except that what anchors its value is something very different. I mean, gold you can use. A piece of land you can cultivate. Bitcoin draws its value from the fact that it originates from a solution of a very difficult algorithm. Okay, so it's a very complicated algorithm. You need a lot of computer power. You need a lot of energy to do that. It has supposedly a maximum fixed amount. It cannot grow more than a certain amount. So that's where that's where its demand is driven, right? What is the purpose of Bitcoin? First of all, the pretense of being independent from central control. And being reliable in value. That's where the original purpose was. I think it has failed both purposes. It also pretended and still pretends to be alternative to traditional finance. I think here the jury is still open. We don't know. There seems to be a lot of segmentation between crypto assets and traditional finance. We've seen it recently with the collapse, which was not extended to traditional finance. There seems to be a lot of separation, but whether it is alternative or not remains to be seen. My plea would be to be very humble. We don't know where the crypto world will end up. So both the enthusiasts and the people that say, let it burn, so to speak, should be a little bit more humble. We don't know. This is part of the experimentation. It can be a diversification instrument. It's not an intermediation instrument, but it can be a diversification instrument potentially, and it is certainly a speculation instrument, right? There's no question about that, maybe primarily. So it could potentially serve a useful purpose in the financial sector, but it depends a lot on how it evolves. So that's why I think that the supervisor has to be cautious, and I welcome the recent direction that have been taken by the banking supervisor and the new CRD, CRR package to apply maximum capital charges to exposures to Bitcoin. I think that's a very good thing to do for the time being until the structure settles. But let's be humble. I mean, let's not claim that these are not socially useful. Potentially, they can be. That all depends on how they will evolve. Partly different judgment, I think, applies to collateralized stablecoins. These are intermediaries. Okay, so they have assets and liability. They're like a narrow bank, so to speak. Okay, so they have a liability on which they offer payment services, and they have supposedly a set of very safe assets that guarantee the stability of the liabilities. I think, and of course, they have one foot in the crypto world. Okay, so they potentially provide a connection between the traditional finance and the crypto finance world. So I do believe that stable coins, if properly regulated and supervised, this doesn't happen yet, have potentially a future, an important future, very much like money market funds had in the 1970s and 1980s, a very similar balance sheet structure than money market funds. So I would, again, suggest to supervisor to look very carefully at the balance sheet structure. They need to be regulated. They need much more transparency than there exists now. But all this, I think the regulatory community and the supervisory community should take a conditional, favorable, prior opinion with respect to these intermediaries, because they can play a role. Now, FTX is more or less the same. FTX or similar, the more recent is what? Is Genesis, the one that is now entered in Chapter 11 last week, I think, similar platform. So these are negotiating platforms, again, with 1 or 2 feet in the crypto world. Potentially they can contribute to all the 4 compartments of finance that I mentioned at the beginning, so both the payments, the intermediation potentially, and certainly the diversification and speculation. The failure of FTX, I think, was a case of very traditional type of finance risk, so excessive risk takings with the additional component of fraudulent risk taking, because they use the client money to take risks. So it's Lehman plus something else, Lehman plus Enron maybe, Lehman plus Enron. So, but this is just to repeat the argument that the financial risk and the fraud risk are very much always the same. And they need to be kept. Now, of course, the digital helped in this case, because if it was not completely digital, they would not have been able to operate in the Bahamas. They would have had probably to operate somewhere else. But again, it's an overlay. Terra Luna. Terra Luna is almost a joke. I mean, it counted on a market mechanism functioning all the time to keep the market price stable, okay? But we know the market doesn't work all the time. It works most of the time, but not all the time. So that's why it collapsed. But again, it could be potentially a diversification. So even more caution in the case of this instrument than with respect to others. But for the same reason, in the same logic, it can play a role. So it's not necessarily socially useless, as some people are now saying. It's not necessarily, just requires a lot of caution until it matures. I'm going to close now. I would have to say a few things about others. For example, payment apps. That's very much on the payment side. But these have already proved their worth by large. I mean, payment apps like Apple Pay, Google Pay, Alipay in China, and the others are extremely popular and extremely efficient and very useful, I would say. So, but they belong, to my mind, they are digital, but they belong to traditional payment structure. Why? Because they are based on the settlement system, largely based on cards and banks, so they settle on bank books, which in turn settle on central bank books. So what you see in the surface is digital. It looks like new finance, but it's not, because underneath there is the traditional finance, which guarantees stability. I said that I would not speak about CBDCs, and I confirmed that. And so otherwise, I would be too nasty. Let me conclude. So, as supervisor, I think you should focus on the business models of what you supervise, and in particular, the finance content of what you supervised. You should separately assess the implication of digital on top of all this and see whether it increases risk, it mitigates risk, or it changes the nature of risk, etc. And I would urge a little bit of a healthy skepticism towards those people who say that digital has revolutionized finance, because it has not. That's it.
Thank you very much, Ignazio. I think you gave us a lot of thoughts for discussion. I don't see any immediate reaction, but please, if you want to say something, any comments, any questions. But I actually have a question, or I have a comment. So I think you made very clear there is a difference about what we typically like to call fintech, like payment apps, maybe peer-to-peer lending. I mean, using digital mechanisms, but in the traditional financial system, and then what some people also call the decentralized financial system, DeFi. And here, I found it interesting. I mean, so I guess I'm more closer, and we're going to talk about this tomorrow. I'm a bit closer to the let them burn side, and the what I would call the tulips of the 21st century side. But you see it more positive. But then actually, you gave lots of negative examples of things where they have gone wrong, about FTX, for example. But so my main question is, I mean, so if I understand correctly, I mean, we're not talking about stablecoins, but we talk about something like bitcoins or cryptocurrency, crypto assets. The value of these, there's no value behind it. It's outside money, as you said. And the only value that could be there is if people actually think it is valuable for some kind of purpose, for payment, for example. If people don't think it's useful, then the generic value should be actually zero, right? So I mean, how do we think about this this difference between this in the crypto assets, the decentralized financial system, and what we typically think about, that behind anything in the traditional financial system, at some point at the end of the chain, there's some value.
Well, first of all, I gave a number of negative examples, that's true, but for traditional reasons, not for digital reasons, right? Because I'm skeptical about, not about finance, which, as I said, is fundamental, but about many financiers. I'm skeptical about many financiers and their motivation. But no, you're right. I mean, there are certain assets that seem to be more distant from real value than others. Okay, but that's true in traditional finance as well. I mean, there is if an asset is useful for because it has different risk-return characteristics from another, regardless of the concrete use that you can make of that asset, that does not provide you with a good, but maybe with a service. Okay, and that may be true or not. So that's why I suggested humility, because this is still moving. So supervisors should be very cautious, regulators should be very cautious, but not necessarily block it at the outset. That's what I'm saying. That's what I'm saying. Okay. So,
let's see. Questions, comments. No? Oh yes, wonderful. Please.
also those bosses are prosecuted right now because of what they did. But from the investor perspective, it's true that billions of euros and dollars disappeared when the prices went down. But what is going to happen when the prices are down? It is an opportunity for new investment. Because when Bitcoin was on 60,000 euros per one coin, it's difficult to invest because you don't know where it will go. Now, when it is again on the bottom, in 1 month it raises from 15,000 euros to 21,000 euros. I mean, the money is getting into the system again. So it would be interesting to explore what is the driver of this crypto system. What is the driver? In spite of all this money disappeared in the last year, this money will return into the system. And again, some investor will get incredibly rich. And others, of course, will lose their money. That was
more or less the point that Thorsten was having. Thorsten was basically saying there's no anchor, there's no concrete value that you can relate to or compare with. That's why it's so volatile. That's where the volatility comes from, because nobody knows the real value. So what you say is true, but that doesn't eliminate the risk. I think one of the problems of Bitcoin is not so much that it's so highly volatile, because there are assets which are on a daily basis more or less as volatile as Bitcoin has been. And actually, in the last 2 or 3 months, it's been quite stable, Bitcoin, for some reason, which I have not yet understood. The problem is that it is extremely opaque. So there is power behind there, and the power stays with the miners, but nobody knows who the miners are. It's a very concentrated market. Most of the Bitcoins are owned by the miners, of course. They are a hidden power that you don't know where it's located, you don't know what their criteria are, their motivations, etc. And so that's what I think, in addition to making it volatile, it makes it dangerous, because that's another negative consideration. But I'm willing to accept the idea that this market has not settled yet. Okay, and so the let it burn proposal, to my mind, makes no sense, because there are risks involved and there are people behind those risks. There are people unsophisticated. So to the very least, you need a consumer protection regulation, to the very least. Okay? So let it burn, but in the meantime, be alert. That would be my suggestion.
Yes, please.
Thanks for a really interesting address. So many really good points. With regards to just what you said about the let it burn kind of argument and the need for consumer protection, one of the things that has been, I think, interesting, but not in a positive way, is to see how the growth of finfluencers has been around crypto, the susceptibility of consumers to searching out for some kind of quick yield, and maybe the lack of financial education for consumers. And then on the other hand, I was really taken by your comment that we as supervisors should be looking at the business model first and foremost. And that certainly in the Central Bank of Ireland is the big question we ask to anyone who comes with a crypto business model, is like, talk to us about your business model, what's the sustainability? But how do you think central banks in the near future what should we be saying publicly to stress the fact that we're looking at business models, but to your point about being humble around where crypto should be, but then at the same time having to be really strong on the fact that consumers are getting burnt. So there's a kind of dualistic message there. There is, be careful, but we're open. And that's a difficult message for a central bank, I think, to navigate. So I'd love to hear your thoughts about that.
I agree. Normally, the consumer protection is not in the hands of central banks, so it's a separate ministerial or government, generally national function. But in this case, I mean, these instruments are so widespread and so they have similar characteristics everywhere. So there is an argument for supranational action, I think, particularly in the European Union. Now, the word influencer that you mentioned makes me think about the influencers in other sectors. So the influencers in the retail sector. I mean, those gentlemen or ladies on the web that suggest to the youngsters that they have to buy a certain type of shoes as opposed to another. And if you have children, you know that they want exactly that particular type of shoes, although they cost the double, and they are exactly the same. I don't know if you're familiar with this problem.
We have both teenagers at home, right?
Right. So this is, sorry, say it again.
At least you have something on your feet.
That's true, but they cost double and there's no value there. So that's another bubble, so to speak. It's not a financial bubble, it's a fashion bubble. But that is all related to digital, I'm afraid, because all this happens in the web. And it's a big power nowadays. So we have to be worried on a much broader scale than the financial one, I think.
I think this corner has a tendency to monopolize questions if you get some statistics out. I'd like to thank you for your insights and contribution. My comment is with regard to the 4 pillars of defining finance that you mentioned. And I was thinking that perhaps digital finance has the capacity to remove 2 pillars. In particular, intermediation and speculation, because if you have the ability to, with digital contracts, DLT, etc., to remove the middleman and have peer-to-peer transactions, peer-to-peer insurance payments without the need of payment institution, isn't there a perspective of disrupting, revolutionizing the concept of finance? And therefore, we're not talking about the 4 pillars, we're talking about something new, something that has happened in other markets as well. Thinking of Uber, Airbnb, and a total disruption, a big disruption of the market. Yeah, disruption is always big. Thank you.
The future is open, there's no question. I think the general direction would be an erosion of the power of established institutions and an increase in the power of the individual, in the sense that the individual can do more on his own without relying on the powerful established intermediaries or brokers or middle people, etc., etc. With the good and the bad, because the individual can act for the good or for the bad. So rules are still needed, different rules probably still needed. But that's all I have to say on this.
Okay, thank you. I would actually just like to comment, because the examples you gave, it basically is like, that's an issue due to centralized providers. And actually an FTX is basically a classical fraud. And actually regulation should be there to protect investors and similar. But in the end, I think nothing fundamentally changed with crypto. For example, with Bitcoin, it still works. People can still send transactions, but the only issue is its volatility, because it goes up and down. But there are many stocks that are going also up and down, probably even more than Bitcoin as an example. So.
Yes, as you said, the fundamentals are still there, right? The fundamental challenges, the fundamental service of finance, but also the fundamental challenges. And they always, I mean, Ponzi scheme is one of the oldest concepts in finance, and I think that was a classical Ponzi schemes. Okay, I'm afraid I have to cut off here because I've been told that the food is getting cold, which we do not want to happen. So, well, thank you very much, Ignazio. Again, let's give another hand. Yes. And let's go from intellectual food to spiritual food to real food. Thank you.